Question: should you believe guarantees like, we can cut your payment in half, or we can get you a 2% interest rate? Absolutely not. This type of advertising is designed to appeal to your fear and possibly to obtain money from you as a result. Read the material on this website. The payment cut in half most likely refers to the partial payment forbearance. The 2% is most likely referring to the Fannie Mae Freddie Mac Making Home Affordable Program modification. Please do not make decisions based on fear. Question: can attorneys or loan modification specialists achieve better results than you can? Answer: no. Learn your loan type first and then follow the guidelines and tips exactly as stated for your loan on operationrest.org. You do not have to pay someone to do this work, as they are following exactly the same procedures, or should be. Question: how long does the process of modification normally take? Answer: usually 30 days for the file to be assigned to a negotiator and 30 to 60 days more for a decision to be reached. However, the period can be longer. Question: what are the possible outcomes of a modification request? Answer: expect a trial modification for 3 months, especially with Fannie Mae, Freddie Mac, FHA loans, and conventional loans following the Making Home Affordable program. If you make payments on time all 3 months, the servicer will then create a permanent modification agreement. For more detail about the structure of agreements along with samples, visit operationrest.org. Also, for loans following the Making Home Affordable program, depending on the servicer, you may be offered a modification based on a lower principal balance to help make the payment more affordable. This is not a permanent principal reduction. It will be treated as a deferred amount that is due as a balloon payment at the end of the loan period, at which time terms can be negotiated. Question: on the subject of interest rates. Answer: while the Making Home Affordable attempts to bring the mortgage payment down to 31% of a borrower's gross monthly income, for Fannie Mae and Freddie Mac loans only, an interest rate of 2% may be offered at least for 5 years according to the guidelines. It will never be lower than 2%. Guidelines say that then it will escalate to market value in a gradual process. See the website for more information. The period of time according to HAMP guidelines can be extended to 40 years to make payments more affordable. We have provided a mortgage calculator on the homepage of operationrest.org. On the other hand, FHA, VA, and conventional loans are located in investment pools or funds that have guaranteed returns. These pools or funds have different interest rates. Expect your servicer to offer a market interest rate. Do not expect 2%, although investors have this discretion, and know that the decision is made according to the investment pool guidelines. Also expect the servicer to offer only a 30-year period and a fixed interest rate over that period. Question: how do you get a loan modification on the second mortgage? Answer: find out your loan type and follow the procedures for that loan type listed on the website. Question: will the servicer review a loan modification request while you are in Chapter 13 bankruptcy? Answer: yes, if 2 procedures are done first. Number 1, a consent form needs to be faxed directly from the bankruptcy attorney to the servicer's bankruptcy area. Number 2, modification documents have to be sent to the bankruptcy loss mitigation home retention area, not the regular loss mitigation area normally. Question: you filed Chapter 7 or Chapter 13 bankruptcy. Is your house protected from foreclosure? Answer: no. If you do not pay the mortgage as directed by Chapter 13 guidelines, and Chapter 13 is a restructuring of your debt, the servicer will file a motion for relief of stay, which will allow the servicer to foreclose on the house. After a certain period of time, after a borrower files a Chapter 7 bankruptcy, the servicer will file for foreclosure. Question: your servicer has your documentation, but you continue to get collection letters from the servicer or foreclosure attorney, or phone calls from the servicer, or solicitation letters from firms stating you may be at risk. Answer: do not panic. Continue to follow up with the servicer using the scripts on the loan pages, and you will always know the truth about your case. Disregard any letters or calls which are not consistent with what your mortgage servicer's loss mitigation department tells you. Collections areas within the servicer do not communicate with other areas within the servicer, such as bankruptcy, home retention or loss mitigation, or short sales, liquidation, or sale of property. Question: you received a collection letter from your servicer or your servicer's foreclosure attorney stating that you need to pay a lump sum payment or to contact them about payment terms. Does this mean you are in foreclosure? Answer: no. You may receive many letters and calls from different areas who are assigned to proceed with collection efforts. Question: you call your servicer and they tell you to send a certain payment, and then they will consider reviewing you for a loan modification. Should you do this? Answer: we do not recommend it. You are most likely speaking with the foreclosure or collections area of the servicer. This is not the loss mitigation home retention area. If you will be requesting a loan modification or forbearance agreement, wait until you receive a written agreement and follow the money requirements stated in the agreement. Question: you are tired and wonder if you should leave the house. Answer: we encourage you not to give up. Foreclosure on one's record is much worse than bankruptcy. Foreclosure can hurt one's chances of getting employment or alternative housing because employers and prospective landlords pull credit reports to screen. Consider all your options first, such as selling your property if other options are not feasible. Question: who is making the decision about your modification? Answer: the entity you may call the lender, such as Bank of America, Wells Fargo, JP Morgan Chase, Litton, or Ocwen, etc., is actually performing the function of a servicer. The servicer is responsible for collecting paperwork and money from the borrower and determining eligibility for and processing loan modifications or short sales. Question: your property value has dropped. Will servicers modify loans based on your property's current value? Answer: yes and no. If the mortgage is a Fannie Mae, Freddie Mac, or FHA loan, servicers can and may defer a part of the principal balance to make the payment more affordable. With FHA, this is called a partial claim. This is not a permanent principal reduction. It will be placed at the end of the loan and will be due as a balloon payment at the end of the loan period. This can most likely be renegotiated in the future. On the other hand, we are seeing some investor-owned second mortgages reduce the principal balances once they complete an in-house valuation of the property. These decisions are made by the individual investors who own the second mortgages. We recommend that you ask if this is an option. We have not seen this with first mortgages yet.